Hi traders, welcome to this edition of Market Outlook Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental driving markets at the moment. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 to 40 minutes. As usual, a lot to get through. Firstly, we'll look at how markets are shaping up currently, and we'll look at one of the key themes which we think is driving price action at the moment. That's the theme to do with higher rates for longer. We've been talking about that for many weeks, and it seems now with the data moving quite strongly positive, especially in the US, markets are now paying attention to that mantra, if you like, from many Fed officials that we have heard from over the last few weeks and months, in fact. We'll look at stocks as well, just their performance on Friday and some of the technicals around some of those US indices. Before then, reviewing last week's key data, which was, of course, the US inflation figures. We'll then look at a couple of data points for the week ahead in the US, those being the Fed minutes and also another inflation data point, actually the core PCE data, which is released on Friday. We'll also look at the Bank of Japan governor nominees, which are on Friday as well, actually, and we do actually hear from the respective governor, the new governor, Ueda, on Friday as well. So we'll just look at some of the key points around that, as well, of course, looking at all the currencies associated with that. So dollar yen, of course, for the Bank of Japan governor, excuse me. And before that, of course, we'll look at the DXY, the dollar index, after the US CPI data, and of course, those two data points that we've mentioned. Hopefully, then we'll look briefly at some of the Eurozone action that's been going on. We've got PMIs out tomorrow, and we've had sort of more hawkish rhetoric really from some ECB speakers, which then has sort of just about been holding up euro dollar. So we'll look at the technicals around that. And if we have time, we'll look at briefly gold, which we haven't looked at for a while, and just look at some of the fundamentals as well as some of the price action, which we're seeing in gold at the moment. Okay, firstly, we'll point to, we've sort of started this chart recently, which measures just year-to-date performance of the major currencies. We can see the dollar's still on the comeback there, Aussie and CAD still leading the way, but those that outperformance, their gains against the dollar have been reduced from last week, especially. But it's probably more important that, or more significant, that the yen and the Kiwi both suffering as the dollar strengthens, certainly. The yen story certainly around sort of those tightening of global financial conditions, if you like, as well as, of course, higher dollar rates that we're seeing in higher treasury yields, and that affects the yen. Especially. Certainly, there's also this chatter around, of course, the Bank of Japan, the new governor. We'll get into that later. But much speculation, actually, and we expect volatility as we go into the end of the current Bank of Japan governor, Kuroda's term, which is in April, of course, so the build up to that could be quite interesting. In the meantime, certainly markets this week are off to a quiet start. The DXY is pretty flat, just a few basis points off, actually, with US participants away for the President's Day holiday in the US. Tomorrow does pick up with those preliminary February PMIs from the Euro area, from the US and UK as well. These are really global activity surveys for each region, which should inform us on the latest state of both manufacturing and services activity. The data actually broadly improved for the first time in months in January. So really be interesting really whether we see these improvements continue. Over to that dominant theme then we were talking about currently, which is one of rates having to go higher for longer. As we said, Fed officials have consistently been preaching this message for some time. And actually, we've consistently been saying it ourselves in our daily commentary, and the fact that markets are thinking or have thought slightly differently. Especially with the US economy, I guess in November, December, it was looking slightly down and out. But since that time, really, it's picked itself up off the floor, really, if you like, and come roaring back to life in January. The evidence for that has come thick and fast. Of course, we've had that 517,000 job gain in the headline NFP, if you remember. Then we had a big jump in ISM services to a really solid expansionary level of 55.2, I think it was. More recently, last week, we've had stellar retail sales, although certainly the weather helped. And then also we've had light vehicle sales surging. And interestingly, even in some of the more troubled sectors, if you like, the housing market and also manufacturing, they've had sort of figures to cheer about actually recently. We had the highest level in one measure of home builder sentiment since last September, and then manufacturing production that increased by 1%. So kind of rarely do we see so many indicators pointing in the same direction. And certainly after, as I said, sort of the US economy looking slightly comatose, if you like, in the latter part of last year, then all those indicators really now pointing in very much contrast to what we were seeing at the start of the month, back end of the year, and then now this pickup in the start of the year, this year. Of course, together with all that hawkish sort of Fed speak, and even putting 50 basis point rate hikes back on the table, this has then driven this big repricing of the Fed rate hike cycle, if you like. Peak rates now above 5.25%, above 5.25%, and nearer towards 5.3%. That's in July, and now there are no rate cuts for this year priced in by markets. If we just look at, we'll look at the DXY actually later, but Friday's price action was quite interesting. All of that said, of course, because the DXY, so that's the dollar index against 6 of its major trading partners, that pulled back actually from near 6-week highs. And along with US Treasury yields, the 10-year US Treasury yield actually hit levels not seen since November. Earlier on Friday, and it was closing or getting close to that key 4% level on the 10-year. The 10-year Treasury yield, remember, is seen as a sort of proxy for global borrowing costs, if you like. So that pulled back actually from near the sort of 4% level, 3.92 it got to, I think. And now that's sort of trading 10 basis points below at 3.82%. Or so, somewhere around there. So a slight pullback after a sort of bullish run in both the dollar and US Treasury yields. And really now the question is whether or how long the dollar still has further to go. And that's obviously dependent on yields and if they can push higher, as I say, nearer or to the 4% key level for the 10-year US Treasury. Equities themselves, if we just look at one of the charts, first of all, we like to go to the S&P 500 really. But Friday session was weak, ending actually with the lowest close print for February. As the market really reacted to those higher rates and of course all that positive data. S&P futures actually have opened up this week, where they've opened up slightly lower as well. Below Friday's close, actually, which is around the 4,085 level, with the key 4,000 level still in play on the downside. If futures really make another lower close in today's session, remember, most of the markets are closed. Futures obviously still trading. It was actually the second week in a row the broad index has fallen, although that loss was relatively small, 0.3% on the week. That said, of course, a drop on Friday added to the worst day in a month on Thursday. The Nasdaq, just looking at briefly, that lost 0.68% on Friday, but ended the week up 0.43%. As I mentioned, yields are the big driver at the moment. In fact, if we just look at these, we don't normally look at them too much, as probably most of you guys don't trade them a great deal. But yields are always important, of course, massive importance, of course, with this 4.5% sort of increase in the interest rate, obviously since March of last year in the US. And we could just see they've picked up and sort of picked up from, this is now the 2-year yield, actually. We concentrate on the 10-year, but just want to draw your attention to the 2-year because that follows the Fed funds rate, so the interest rate in the US most closely. You can see there on Friday, we popped up to 4.71%. And we haven't hit that level, as I said, since sort of November, where we topped out, really. So be interesting, just consolidating here again near these recent highs. So interesting whether then that can push up towards that high that we saw in November on the 2-year, around just below 4.9% there. For the 10-year Treasury yields, you can see again, as I mentioned, that pop up to 3.92, got beyond a sort of late December levels towards, where were we, early November, and then we pull back. So will be interesting to see what happens there as a guide for the dollar. But for equities as well, there'll be a driver, of course. If yields go higher, then potentially then that makes it tough for stocks to stay at their current levels. Remember that yields rise when bond prices fall, and then if we get high yields, plus as well, of course, we've had the lower earnings estimates recently, that kind of means potentially to us sort of renewed headwinds for stocks, which is still quite expensive. So technically then we can see this is the S&P 500. If we just drop to the weekly, actually, quite a few confusing lines in there. If I just take out probably, actually, well, I'll keep in these Fibonacci levels. We like the Fibonacci levels on the weekly. Really, we can see some consolidation, really. Sort of prices for the last couple of weeks, at least, being inside that weekly candle from the end of January. So a couple of inside weeks, really just denoting consolidation, really. The upside really probably capped by the 100-week moving average at 42.13. You can see there. And then the halfway point of last year's sort of decline, which is at 41.55. This is the S&P 500, of course. So a couple of levels there on the upside, which may cap further moves higher. Then below, we've got the 50-week moving average of just above 4,000, 4,015. And then we've got the 38.2 fib level just below 4,000 there, 3,998. So that's those levels. 4,000 again always happens around a big number, really, but a few other levels there to take note of, all around the 4,000 level, and that being a big level of support. On the daily, we can see just sort of quite messy price action, but that pullback from dropping below a sort of new low there. The low was at 4,047, so it didn't quite get towards 4,000 or so, and then we closed higher, like above at 4,079, sort of back in this mix really. We had pointed out those December pivot highs around 4,100, so could act as potential resistance, but just messy price action really, above sort of 4,000, but below sort of 4,200 now. That's on the S&P 500. On the NASDAQ, we did, this is the NASDAQ 100, remember. We got close to the big fib level. That's at 12,947 a couple of weeks ago, at least anyway. And again, we've sort of been messy consolidating sort of around sort of 12,500 or so on the NASDAQ 100. Support really mid-December top at 12,166. Then we have the 200-day moving average at 11,934. And then the upside probably capped around here above 12,800. On the Dow, on the weekly, I think good to show you the weekly, just this consolidation, continued consolidation, can't break 34,281. You can see we've consistently pointed that out as resistance. We keep on tapping it and then falling back. You can see, just blow that up, you can see 3 doji candles really over the last 3 weeks, really denoting consolidation, slight indecision really, and the longer we sort of track sideways, the stronger the range expansion that we should see, and the breakout, either if we do break above that 34,281, or then probably the support, really sort of close support is obviously last week's low at 33,517, and then we sort of have 33,273 below that. That's for the Dow really. We just touch on a couple of the other major indices. The DAX on the weekly, you can see a couple of weeks ago we had a high 15,658, not seen since sort of the start of last year. Couldn't quite push above that last week, so looks like consolidation again. You can see that on the daily, consolidation around the highs, long-term full trend, so potentially looks like we push above sort of 15,600, then we're off to new highs, cycle highs at least, as long as we sort of keep around sort of that support level above 15,200. That's on the DAX. UK FTSE, you can see we highlighted that a few weeks ago, actually breaking to all-time highs. We got that on Thursday, 8,047, although we closed just below that 8,012. That beat the previous peak in May 2018. Friday's candle to us looks quite positive, really. Again, we dipped below, but then closed towards the highs. As long as we consolidate around here above, we've got a long-term high, long-term support really of around 7,900. So as long as we stay above here, again, that trend, medium-term trend at least, is bullish. So this looks like bullish consolidation, and then we break above 8,047. That's resistance above. Okay, those are the stocks and the indices, the major indices. We'll now look at just a quick review of last week's main event, which obviously was the US CPI data. Got a graphic here reviewing that data, which we can see the headline print 6.4%. And you can just see some sort of some of the stats we sort of jotted down really for the headline print. So all in all, really, you've got the annual core there, you've got the month-on-month core, and then you've got the headline, the year-on-year, and the month-on-month. January inflation data all in kind of suggested this disinflation process which Jay Powell has mentioned. It might be more prolonged than previously believed. The CPI inflation print, that was 1/10 stronger than estimates, and the headline that rose by 0.5%. Just pulling for some of these figures out from the graphic. 6.4% year on year, of course, 0.5% month on month. Core increased by 0.4% month on month, 5.6% year on year. The degree of outperformance is probably pretty small, just 1/10 here or there. But the details do suggest a firmer path of inflation from less, if you like, disinflationary support from core goods and more persistence from services and food inflation. We have got actually a chart here. You can see that sort of persistent price pressures from services, the super core inflation. So that is basically core, less excluding food and energy, as well as excluding shelter. And you can see that red line is still elevated, still hot at 7.2%. There's so many charts, I should point out, that sort of explain, show you sort of CPI data. So many different means of looking at it. The super core inflation data we focused on here because Jay Powell has stressed the importance of that going forward. Of course, you can get different measures, as I said, as well as the core. You can get trimmed mean, which take out the sort of big outliers on the upside and downside. But for this time, anyway, we're focusing on this super core inflation data, and just it's still being elevated. Just before we go on to some of the other bits of data, which obviously have surprised to the upside, we also got on the inflation side, we got the PPI data. So that's a producer price index, and that actually surprised strongly to the upside. Headline PPI, that increased by 0.7% month on month, well above the forecast of 0.2%. And then other measures of PPI, the core and the measure which is called the core, so that excludes food, energy, and also trade. They were both above expectations as well. So yes, price pressure is still elevated, still really staying sticky, if you like. And it's interesting that, well, in the initial aftermath of the CPI data anyway, markets sort of didn't react as much as kind of you thought they may do. Treasury yields, they did push up, but was kind of muted, all things considered. And even with equities, they seem fairly relaxed, actually, about the inflation figures initially. The S&P actually ended virtually unchanged on the day. The NASDAQ actually rose, but there was quite a bit of volatility in FX. Nothing major, as I said. And really sort of on balance, was, yeah, an interesting initial reaction. Looking further out, I guess, just on the data especially, most economists have adjusted their inflation forecasts higher. But they still have a sort of 3 point something still expected by many economists by the end of this year in the fourth quarter. Also similar revisions to the outlooks for PCE inflation. That's sort of seen around 3%, 2.9% for the core in the fourth quarter of this year. So that's coming down still, it's seen as anyway. And then interesting, if you continue to expect a sort of mild recession, then restrictive monetary policy and fading supply side factors will probably drive inflation back towards or nearer towards the Fed's 2% target. That then means the May March and May hikes probably still very likely for the Fed, those probably being 25 basis points at the moment. And then the Fed might have to hike further if then inflation does stay sticky, job growth still remains punchy, if you like, and consumer demand refuses to soften. You kind of think if you're in the Fed's shoes, with, as I said, sort of 4.5%, 450 basis points of hikes already done since March of last year, and we've still got this strong data, still got elevated sticky inflation, then yeah, we're looking at still more rate hikes. March, May, potentially June, then means the terminal rate pushes up to sort of 5.25%, 5.5%. And then we don't get a first rate cut until sort of March of next year. A lot depends, obviously, data going forward, and that's obviously what's pushed and changed markets pricing of that terminal rate. If you remember, it's sort of 4.9% at the start of the year, I think even below that. So we pushed quite substantially higher in a relatively short space of time, all on this data, and then obviously the hawkish Fed speak. Just another piece of data just to highlight January retail sales. They came out clearly above expectations, 3% headline rate, 2.6% I think on the core. The core sales again excludes motor vehicles, gas stations. And well, some were obviously suggesting warmer weather likely helped contribute to the upside. Sales actually recovered broadly across all main sectors. And that was actually consistent with earlier positive signals from leading indicators. Other data points, we mentioned housing data. I think that came in better than expected, as well as Empire, New York Fed's Empire Manufacturing. That also surprised to the upside. And actually, notably, the prices paid index of the latter of that manufacturing index rebounded from January lows. Okay, just looking at what's ahead this week. We'll just show you the DXY. Actually, two main data points, as we said this week. The FOMC minutes of the February meeting at the start of this month, where, if you remember, the Fed obviously hiked by 25 basis points, but the debate moved away from the size of the hikes to how many remain in this cycle. Again, if you remember, Powell's press conference was relatively relaxed. He said the disinflationary process had begun, and that really sparked the market's interest, if you like. But he also said, of course, that FOMC will remain data dependent, with policy still not sufficiently restrictive. And as we just said, it really does seem that way, appear that way now with all the strong data. The focus then will be on how close the Fed probably was to hiking 50 basis points at the meeting earlier this month. And the market could kind of be sensitive to, of course, suggestions that that bigger hike, the 50 basis point hike, had been a closer call. Of course, that said, we have to kind of remember that we've had that strong data, strong macro data. We've had continued we've had continued strong or a Fed's aggressive message, if you like. And so, in a way, the minutes might be slightly outdated by now. Just something to bear in mind, really. Then Friday, we get the release of that more inflation data, core PCE deflator data, the Fed's favored inflation gauge. That's expected at 0.3% month on month. In January, the annual rate seen unchanged at 4.4%. So this data will definitely shed some light on that disinflation story, especially in the context, of course, of the higher CPI data and also that PPI data, which we talked about. The data, the core PCE usually runs a bit lower below the CPI data, but it could outperform this month as the weakness in core CPI was driven by components that don't actually impact the PCE estimates. So yes, a couple of data points there to look out for this week on the US side. For the DXY, you can see we've kind of reclaimed some of those heavy losses since the October highs. Of course, we've reclaimed about a quarter of that sell-off so far. We've had, obviously, as I said, bullish, more aggressive Fed speak still. Recently, we had Mester and then the arch hawk Bullard. They sort of favored 50 basis points. No surprise from Bullard. We could just kind of, in a way, discount it because he is consistently hawkish, one of the most hawkish members on from the Fed. But certainly, this talk of 50 basis point hike hasn't sort of been mentioned really most recently. So we may get more speakers on that line this week, then potentially changing the odds of a 25 basis point hike at the 22nd of March meeting, which is nailed on at the moment. DXY, then we could see technically, you could see, just as I mentioned, that sort of pullback from that high at 104.66, and we just pulled back below there for the minute. Again, we highlight we were trapped in that range, 103, 103.82 or so, long-term sort of support resistance levels that we've consistently pointed out, and we've just broken above there. So if we stay above that 103.82 level, potentially then we can push up higher towards sort of 104.66 and above potentially. Support then lies at or in that zone, which is also you can see the 50-day moving average at 103.30. So that's the DXY. What else do we have to look out for this week? We think the Bank of Japan governor nominees appearance at the lower house in Tokyo. That will be important. That's on Friday. That's for the lower house appearance, actually, and then the upper house appearance apparently is touted for Monday, the February 27th, although that is yet to be confirmed. If the nominees are approved by both the House of Representatives and the House of Councillors, then the Cabinet will appoint them to their proposed positions. So Ueda's speech, he's the governor nominee, that will be key, really engaging if we get a clear stance from the Bank of Japan governor candidate ahead of Kuroda's end of term on April the 8th. What are markets expecting? Well, they think we should possibly get a hawkish tilt from the BOJ. Really interesting at a time, of course, of hot CPI and wage data. And I think, in fact, we do get Japan CPI data later on this week, which is expected to be higher than previously, 4.5%, I think, from 4%. But for the governor, the initial reports had suggested, actually, interestingly, that Ueda was obviously, when he was touted as the forerunner, the front runner for the top job, that was kind of met with a mixed reaction by markets. If you're on Twitter, especially, then there were so many analysts kind of really trying to find articles about Ueda. Actually, we went back to 2016, actually, where he was kind of critical of Abenomics at the time. But then more recent articles, July last year, I think Ueda warned against raising rates prematurely, but said the Bank of Japan must eventually consider how to exit from this ultra loose policy. And then in more recent commentary to that, Ueda sort of in February said the central bank's monetary policy was appropriate, actually, and it needed to continue its brand of easy policy. Interesting then, sort of conflicting sort of pieces from Ueda in the past. Not that much known about him sort of recently. I know there have been some sources reports out of the Bank of Japan, a former staff secretary, actually during Ueda's time as a board member, sort of saying that he was likely to allow the data to guide the exit timing of a policy switch. Nonetheless, of course, we will all be on the lookout, markets, us, be on the lookout for hints on when, how, and to what degree Ueda may steer the Bank of Japan away from its current policy. It kind of doesn't suggest that the Bank of Japan will be in any rush to change direction, nor does it mean, of course, that the Bank of Japan policy will be able to move far from its current settings. Interesting, really, kind of how big this window of opportunity is for the Bank of Japan to normalize policy, really. If you think that other G10 central banks are potentially cutting rates in 2024, then the kind of that window is pretty short. So really interesting times for the Bank of Japan, really. Whether those changes are really moderate in nature going forward, which kind of seems probably more appropriate. Although I have seen stories actually even this morning hinting potentially at the next meeting, the Bank of Japan's next meeting, I think in early March, the 10th rings a bell. Whether we do get tweaks by Kuroda setting up Ueda. Interesting stories about that in the press, which kind of whether that is more unlikely because it sets a clean state for Ueda and what he wants to do. Technically then dollar yen, the yen has been weakening on yield pressure, of course, rising yields put pressure on the yen. And we've highlighted this before. We've broken out of that descending bear channel, sort of traded just below the 50-day moving average at 134.84, and then we just pushed up higher then and sort of tracking sideways again. Again, you can see that push up to that high 135.11, sort of failed to close above there, and we sort of track sideways again today. So that high 135.11 again, key resistance really to a move up towards sort of potentially 136 and above. That's where you've got the 200-day moving average actually much higher, 136.92. Otherwise, support probably around 132.70. So that is the halfway point of the October move down, and then below that, we've got that 50-day moving average at 131.84. So that's dollar yen technicals. Probably getting close to wrapping up, really. Probably look at we'll briefly look at gold and then some data actually for Europe. Gold, really, yes, a big fall down, obviously, from that peak in February 1959. You can see those overbought conditions really drop now below 50 on that daily RSI, now at 40.4, but we're trading below that 50-day moving average at 1862. So that probably caps the upside or acts as resistance. And we're just trading around, interestingly, around the halfway point of actually that 2022 high and then the 2022 low, in fact. So the halfway point is around 1842. We're trading just above there, you can see. So that'll be a key pivot point really for prices going forward. Of course, we've had this uptick in geopolitical tensions between China and the US. They met, I think, over the weekend in Germany. Didn't really get too far. Barbs thrown by each of them, really. So that's given a slight bid to gold prices that we can see. But really, it's really around sort of rising yields, interest rate hikes from the Fed, really, which potentially may hurt prices. Investor sentiment was also being challenged again by bullion-backed ETF holdings. They fell to a fresh 3-year low actually on Friday, while open interest in COMEX gold futures, they've fallen by 16% during the past month. Really as speculators, traders, big traders, funds cut their exposure both long and short. If we do get further dollar-led strength, so we get gold weakness, that could target, as I said, support. Then next will be probably last week's low around 1818. And then also we've got 1828 just above that, which is a 38.2 retrace actually of the run up from early August. Haven't got those fib levels in there, but that's a 38.2 retracement level at 1828. And then below that, probably 1792, 1776, there's an area there of support. So that's much lower down. So a couple of technical levels there on gold, as well as a couple of fundamental reasons actually to look out for going forward for the week. Finally, let's just quickly look at euro dollar. You guys still listening in, so that's good. Euro dollar, first of all, we do have those latest business surveys, those PMIs I mentioned. They're really crucial in shaping really the outlook and providing really an early glimpse into how corporations really view the economic landscape for the first quarter of this year. Previous round of surveys in the Eurozone painted quite a rosy picture, actually highlighting an improvement in growth momentum, suggesting really the region might escape the recession. After all, those hopes obviously underpinned the euro. And it's important to stress actually that a lot of that progress was due to warmer weather conditions, because new business orders kept falling. And it kind of suggests that growth will be very anemic in the coming quarters. Whether, of course, this pattern continues in the February surveys could decide, of course, where euro dollar goes. The PMI readings are seen hovering actually around the 50 area, and actually the market may take more notice of the Chinese PMI readings, which come out later this week. So that's something to bear in mind. Yes, just on Eurozone. Otherwise, we've had mixed messages actually recently from ECB speakers. We had the hawkish Schnabel saying that investors risk underestimating the persistence of inflation. And that kind of bolstered bets with money markets actually pricing a 3.75% peak now in the depo rate. But then we did have a dovish member, Villeroy, saying rates are now in restrictive territory, and that they may raise above 3%, but it's not automatic. So again, this battle between the governing council members, hawks on one side, doves on the other. Really, we should, I think we mentioned this last week, actually, we should expect this battle to be ongoing really up to the ECB meeting next month. And for euro dollar, well, we can see we did actually manage to avoid a third consecutive lower weekly close, and we did close above key short-term support actually, which we see at 106.60. The breakout from the February range, if we do break out then conclusively below that 106.60 level, then potentially that would apply big downside risk, or especially towards 105, the lower 105 region looks likely. Otherwise, then the upside probably capped by that 50-day moving average at 107.26. And then you've got sort of that range high, which is at 108, just above 108. So interesting times for the euro dollar. I think we will wrap it up there now. Just checking out those charts. I did have retail sales charts, which I showed you. Yeah, we'll wrap it up there now. Been around 40 plus minutes or so. Please do follow us on social media, also on our daily market commentaries that are always posted on the website, where we look at markets in general. We have a sort of event takeaway or event data breakdown, or some market thoughts every day, as well as a chart of the day, which we think is relevant for the events of the day. So do check that out as well. Great to speak to you, and we look forward to speaking to you again same time next week. Okay, take care out there.